Welcome, everybody. Shannon Flanagan coming to you on behalf of Retail Wire as one of their Brain Trust members. Thank you for being here today. So hard to believe we're more than halfway through 2025. And if one word could describe the retail landscape so far this year, it's volatile. Retail is never boring after all. It's one of the reasons why I love being in this industry. And this may be the least boring year of them yet. I've heard from many retailers and retail adjacent dependent companies that this has been a harder year than 2020. And if there's one word about foot traffic, it's inconsistent across time, by product categories, by regions. Macro pressures like inflation worries and tariff threats continue to shape how and where consumers shop. The fact that warehouse club traffic surged, I think, upwards of 10%. My partner here today will keep us honest. Right before tariff deadlines tells us something, that shoppers are both price sensitive and globally aware. And then we've seen sectors like quick service dining, they weren't immune either with what happened with egg surcharges. And we'll talk about that in a second as well. And it doesn't just stop at the economics, right? We know what we're living in every day. There's the immigration policy headlines, government restructuring, consumer protest. We're living in very uncertain times. And this has all created a lot of ambient noise. In some cases, we see direct impact to markets, and some we don't. So again, inconsistent, volatile, and uncertain. So in short, 2025's first half has challenged many of our assumptions about the predictability in retail, which seems a little bit like an oxymoron, but it's never been more unpredictable than it's been. We're seeing the trading up and down. At the same time, price resistance paired with splurging, and a shopper base that's reacting not just to price tags, but to headlines, fear, and cultural moments. That's why this is a conversation I'm so excited to have. I know it's going to be very insightful. I'm joined here by RJ, whose expertise in shopper analytics, traffic patterns, and consumer behaviors will help us decode what this wild, now 7th month ride has maybe been, and what to expect for the rest of the year. So ready for you to take it away, RJ? Go ahead and introduce yourself, and let's get down to the good stuff.
Yeah, I think you may have covered it. I think we're done here. So I think we've done our job. Now, hey everyone, it's RJ Hottovy. I'm the head of analytical research at Placer AI. We are a location-based analytics company powered by mobile data. We'll get into what that is in a minute. But I've been at Placer for a little over 4 years now. Prior to that, I was a Wall Street analyst covering the retail, restaurant, CPG, and e-commerce sector for about 20 years before coming to Placer. Placer, we work with a lot of retailers, restaurants, CPG companies, really help them kind of understand what's going on from a big picture macro perspective, what's going on from a consumer behavioral standpoint. Placer's foot traffic data is really good about helping out, especially in this period of volatility. And I agree with you, Shannon. It's been one of the more up and down years that I can remember. You probably have to go back to 2008 with the Great Recession to kind of find a year that reminds me of all the volatility that we've had, excluding the pandemic years, of course. But it's been really an up and down year. So quickly, what we're going to cover today, with just a quick introduction on Placer AI for those who aren't as familiar with it is, then we'll get into those first half retail trends because I think that really is telling and really is important to dive deep. Then we'll spend a little bit of time on malls. Hopefully at this point, I think most people have come to realize that malls aren't going away. They're just being reinvented. We'll cover some of the topics there. And then certainly we'll save time for Q&A at the end as well. So just a brief introduction on Placer AI, how it works, how we get our data. So we are a location-based analytics company powered by mobile data. What do I mean by that? What I mean by that is we can come up with foot traffic estimates for really any place in the United States, effectively anything you can draw a shape around on a map. So that covers retail stores, shopping malls, restaurants, airports, downtown areas, anything you can draw a shape around on a map, we can get foot traffic estimates for going back 7 years. The way it works is we partner with several dozen mobile app companies, and through those app partnerships, we get 24/7 data on a panel of over 25 million devices. From that sample, we are then able to use the latest in machine learning and AI and extrapolate based on various variables from that region to come up with a full estimate for that particular location. At this point, we work with over 5,000 customers who've all gone through a due diligence process with our data. Feel pretty good about the accuracy and the reliability of the data. Importantly, too, we don't collect any personal information. All that is stripped away before we receive it. We are just know that a device has gone into a certain zip code or a certain polygon on a map, and that's how we derive that sample from it. But I'd like to think we're much more than just a foot traffic company at this point. I like to think of Placer's data as kind of the what, how many people go into a particular location, how long they stay, where else they shop after. It's our third-party data sets that we put on top of it that really unlock the why and the how of any situation. So things like demographic and psychographic data. If we know a device goes back to a certain zip code block at night, we can infer certain things about that zip code block through our other data partners. So a lot of cool stuff. If you haven't seen our platform in a while, there's a lot of cool things that can hopefully help out whatever business you're in, retail or retail adjacent, things like visitor journey, things like event studies, things like cannibalization risk, site selection, you name it. So check us out at Placer AI. We've got a lot of free content, a lot of cool things, a lot of free stories as well, and free data. So please do check us out.
You talk about we have grown a lot as an industry. When you think about 20 years, this was data that everybody wanted to get their hands on. So I one day want to geek out on it as well.
You can lose a lot of hours diving into it too.
Totally.
I've been there. So anyway, Shannon, let's get into the good stuff and talk about the first half retail trends. So wanted to set the stage here, and we've talked a little bit already about the ups and downs, and I think this slide perfectly encapsulates what's been going on. So effectively what I'm showing here is we've grouped together the 100 largest retailers and restaurants into one consolidated index, and you can really see the roller coaster take place. So we started out pretty strong in January. A lot of that was the fact, if you remember back to January last year, we had some snowstorms, so it was definitely weather. And then we got to the second half of January, started to see year-over-year trends start to decline. And then as we move further into February, we saw even greater declines. I would say at this point, it was at this point this year that I started getting a lot of inbound questions from our retail and restaurant and CPG customers asking about what was going on. Initially, those first couple of weeks in January, we thought maybe it's a post-holiday hangover. People spent too much. But then it became clear as we started to see the declines worse, and it was probably more than that, based on the fact that it was really every category that was impacted. It really did seem to be more macro in nature. And I think, at that point, we're starting to hear a lot of headlines about potential tariffs. We were starting to see headlines about egg inflation. We were starting to see things about immigration headline stories. We were seeing, potential consumer protests. We were seeing things about government restructuring. I think this really just led to a lot of uncertainty, and that led to consumers pulling back. Even if we do account for the fact that February was a shorter month, 28 days versus 29 days a year ago, it was one of the weakest months we'd seen in several years in terms of year-over-year retail trends. Now, as we got to the end of March, we started to see a little bit of recovery, and part of that I do think was the fact that consumers were trying to get ahead of tariffs. If we've learned nothing else this year from our data, is that consumers are extremely price aware. They will try to get act if they think they can beat a price. And so we did see some activity ahead of the initial tariff deadline. Obviously, that did get extended to 90 days. And so after that, we started to see a little bit of a normalization period. April, May, generally speaking, things were up year over year. Consumers had kind of settled down, weren't seeing many price increases at that point. And so I think we kind of hit this normalization period until we got to June. And then June, we started to see a change in behavior again. We started to see some of the consumer protests that we saw in early June have an impact on consumers. We started to see the reemergence of tariff implementations start to come back in the headlines. And so we saw a step down in terms of behavior year over year. And that's kind of where we're at right now, is that I think some of the normalization period we saw, the wait and see period, we're starting to kind of ease in and have a little bit more uncertainty as we kind of enter June and July. And that sets the stage for what could be a continued roller coaster here, the remainder of the second half of 25.
Well, something I found really interesting as I was diving deeper into this topic, RJ, is that according to Forbes, the administration has made roughly 28 significant policy reversals or flip-flops on tariff rates, the deadlines, the effective dates, the exemptions since Liberation Day. And I think we absolutely are seeing that in the results that we're going to be covering.
Yeah, I think you're exactly right. I do think that just this general uncertainty, led to that. Certainly, the first quarter, that was a lot of volatility, and then consumers started focusing on the prices. And honestly, we did not see a lot of price increases at that point. Now, since mid-June, we have started to see a little bit more. We did see inflation kind of reemerge to that 3% range on the most recent update. And I think consumers are starting to see that a bit more, whether it be the fact that, most retailers have, mobile shopping apps, things like that. Consumers can price shop pretty quickly these days, and they do remember how much they paid last time. So I think it's interesting that we do have a very hyper-aware consumer that is willing to jump ahead of things. And we did see a little bit even in July. That little spike we see at the end of July really was warehouse clubs driving a lot of that as people were trying to get ahead of tariffs. So kind of interesting to watch the data play out here. So we've already covered a little bit of this, but just kind of wanted to bucket the different factors that we're seeing right now in terms of the importance. I'd say there's kind of three things, and they're all intertwined with one another. But the primary factors that are driving that volatility that we see is macro concerns. I think is number one. Just people are uncertain, where we stand with the macro perspective. You did say a lot of confusion about tariffs. I think that has been a big factor in that too. We also see inflation really is top of mind after a couple of years of not only food inflation, but we've also seen it in healthcare. We've seen it in rent costs. I mean, consumers are paying more for a lot of kind of the consumer staples out there. So when we saw the egg price surcharge that kicked in for Waffle House and Denny's back in February, it had an impact on visit trends. So consumers are hyper aware. So I would say those are kind of the three macro factors that are impacting things right now. And we kind of have some explanation behind that as well. There are some factors that we also I would put as important, maybe not as important as macro, but they're certainly having an impact on overall results. And I would say, immigration headlines would be the number two. We've been getting a lot of questions about that. And I think certainly it's had some impact on overall retail visitation trends. There's a couple of ways we can look at it. One is we can look at data from border cities. And generally speaking, that's been a little bit more mixed, that data. I think you've got two things going on. You've got potentially more people in a lot of those markets. We've seen population growth in a lot of the border cities over the last couple of years, which may be masking some of the changes in Hispanic consumer behavior in those markets. What we have been able to see is when we look at stores, say, for example, chain stores that are in largely Hispanic trade areas, generally speaking, there's been underperformance. And it generally depends on what chain and what markets they're exposed to. But we have generally seen that those stores that are largely in Hispanic trade areas have, modestly underperformed their system averages. Now, we've seen a little bit bigger impact in Southern California, to a lesser extent, some Texas markets over the last couple of weeks. But it is having an impact. It just is more pockets around the country is the way I'd describe it. Government restructuring is another one that got a lot of headlines early in the year. I'd say this has been a little bit more muted in terms of the impact. We haven't seen a lot of change in the DC market and other areas that had large percentages to government workers. The last one that I think is worth keeping top of mind here is consumer protests and boycotts. We have seen some impact from that. I would say it's largely at the brand level. I would say kind of on a consolidated basis, it's been more macro concerns, but there does seem to be some truth that some of the consumer boycotts and protests are having an impact on overall trends to trends for specific brands.
And one of the things I think will be interesting to see is that we do hear in headlines at least once a week, pretty big companies laying off big percentages, relatively big percentages of their workforce. And I think we'll start to see, or one of my predictions might see that we start to see more of an impact of what's happening there. And we know in particular, our industry is being very hard hit.
Yeah.
By layoffs. I think the last I read was something well over 70,000. We're actually leading all of the industries in terms of layoffs.
I think you're spot on. I think that is something that you have to keep in mind too, is the combination of potentially higher prices with tariffs going into place, layoffs, as you pointed out, it certainly hit the retail sector. It certainly hit the restaurant sector. It's hit other areas like technology as well. Yeah. And layer that on top of just general uncertainty, it sets the stage for a bumpy ride in the second half of 25. So let's dive into some of those topics in a little bit more detail. And this has been fun to look at, just kind of the fact that you see pretty immediate impact from tariffs. And we see it across the board, or at least ahead of tariffs. I mean, nothing like a potential price increase to drive consumer behavior at this point. You do see some ups and downs here. We did see a little bit of spike ahead of kind of the initial tariff implementation period in April. April 1st, we saw visitation trends to dollar and discounted grocery stores up then. You see that big spike in mid-April, which was largely Easter. But generally speaking, we continue to see consumers bias towards more value concepts. So things like dollar discount, superstores, warehouse clubs, value grocery continues to be very good. And actually traditional grocers who've cut back on prices are holding up very well too. But it kind of shows you again the roller coaster that we've been on this year, kind of looking at different categories. But I think the strength in dollar and discount, and one thing I should point out, this is absolute. So this is going to incorporate both new stores that those chains may be opening up, as well as an increase in visit. If you remember back to 2024 was a tough year for a lot of dollar stores. And so what we are seeing is a little bit of that lapping of last year's pressure as well. Now, what the impact of this is too is it's changing behavior, in certain retailers, and what we're seeing is a bit of a waterfall effect here too. So one of the things we've seen is kind of that lower income consumer is now going to dollar stores more. They're going to value grocery. They're going to others. But what's been most interesting to us is really this change in middle income consumers, middle to upper income consumers. And Walmart's talked about this before on their conference calls, the fact that they've seen an increase in that higher income consumer. And what we see with our data, what I'm showing on this is the change in percentage of visits from trade area based on household income. And we do see the biggest pickup for Walmart is in trade areas with household income really above 100,000. You may be sitting here looking like, oh, there's only a 30 basis point increase in that. Well, if you think about how many trade areas Walmart touches, that is a significant increase. And so that is still pretty meaningful when we look at that. And so you see this waterfall effect right now. You kind of see that middle income consumer trading down from specialty grocers and other discretionary retailers more into the mass channel. You see that low income consumer trading down from Walmart, which you also see in the other part of this chart, into things like dollar and value grocery and other channels like that. So you do see with the data when we overlay some demographic and household income data on top of our data.
Well, and they've made a very concerted effort for a number of years now, but I think we're really seeing it to be top with Amazon, right? And their e-com growth, I think, was something like 20% last quarter, if I'm not mistaken. So not only are they seeing it in the foot traffic and those trade areas, but overall, as their offerings get better, and they are killing it with AI. So I think that we're seeing what leaders get when they're investing in those spaces, both for their employee and their customer.
Yeah, one of the things that's been interesting for us to look at too, again, even with e-commerce, it's still dependent on physical assets and fulfillment centers and things like that. And so when we look at visits to Amazon and Walmart fulfillment centers, obviously first quarter was very strong. And so that's one of the ways that we're kind of giving a more comprehensive view of what's going on too. So our data completely says that too. Seeing a lot of visitation trends to Walmart's fulfillment centers. So we agree that it's something that I think is continuing to play out. And you're right. I think a lot of the investment that they put in is really starting to pay off. And in a lot of ways, they have narrowed the gap with Amazon on a lot of fronts. Warehouse clubs have been, and you mentioned this at the beginning too, Shannon, but it's worth revisiting here too. Warehouse clubs have been one of the real breakthrough stories in the retail space this year. And again, this is the year-over-year data for Costco, Sam's Club, BJ's. Not a surprise that they're up. The companies, the reported data backs it up as well. And again, this is going to include both new store openings as well as comparable visits in this data. But I think what is interesting about this, we just talked about that, household income for Walmart is going up. Well, Costco is going the other way. If we look at household income across their trade areas, we're actually seeing a decrease. We're actually seeing that number come down. And when we look at the data and kind of put some other lenses on it, what we do see is it's actually been driven by a younger consumer, which maybe has a lifetime of transactions, but is a lower income consumer at this point. It really is that younger consumer driving a lot of that visitation growth. So it's a younger millennial family, it's Gen Z families. In a lot of cases, maybe they're buying their first home. That has really been the driver of Costco and the warehouse club channel in the recent years. And it's interesting kind of bucking the trend from some of the other channels that we've seen on that front.
Well, and this is a retailer's dream, right? That the younger, the better, that they can pull them in. And I think we're going to continue to see, Costco is just one of those superstar, rock star stories in retail. But I think it comes down to, right, their relentless focus on the customer experience as well as the employee experience.
Yeah, obviously within that too, the merchandising side too. I think that they have been exceptionally strong, navigating this uncertainty and finding the right products, especially in this day and age where consumers seem to have a shorter attention span when it comes to product cycles than ever before. Really, to their credit, they've done a good job, and it really comes down to kind of what has really worked in this environment is this kind of idea of not just low prices, which obviously they're known for, but innovation too. A little bit of this treasure hunt atmosphere, and there's a little bit of that element going on at the warehouse clubs. I'm going in there for low prices, but there's a lot of things that I didn't expect to see here, a lot of innovation on that front. So this idea of innovative value, we see it with the off-price channel, which has done really well. We see it with some other categories. I think, even Aldi and Trader Joe's have really done a good job. Kind of there's this idea that we add a lot of new flavors. We have the ability with our private label to do some interesting things, and there's certainly shades of that with Costco as well. I mentioned this too, and I think it's worth kind of revisiting too. Dollar stores, had a tough 2024. We had announcements about store closures across a couple of the chains. Obviously, we saw Dollar Tree and Family Dollar separate. And now we're kind of in a position where there was a lot of uncertainty for these chains coming into 2024. There was a lot of discussions about how they overexpanded and what was going on. Now we're entering 2025 where, actually the numbers are looking pretty good. And admittedly, there's still some store growth taking place and driving some of these numbers. And I think, the April 14th, I think that was largely just because we were lapping Easter, and there was partially some impact from there. But generally speaking, it does start to feel like a lot of the dollar stores are more stable footing, whether that be they've, stabilized, senior management teams on a lot of these chains. Perhaps they've kind of gotten back to the right merchandise assortment. Perhaps, pricing is better aligned with what consumers are looking for on that front. But it has been interesting to see that, dollar stores have started to recapture some of the share maybe lost last year. It's interesting too where they're taking share from. We mentioned that at least the lower income consumers trading into this category from Walmart. Certainly we're seeing with groups like QSR. That group has started to trade in a dollar store as well. So it's going to be interesting to see as we kind of move into the back half of the year. If this continues to be a trend that dollar stores continue to remain disruptive on the overall category.
I mean, one of the questions I have, because I'm not surprised that we're seeing the return to the growth for all the factors you just said, but their margins are much slimmer. They have a lot less wiggle room. They've got a lot of their products coming from China with that new price increase, or I forget what it was, something right under $800. I'm going to fobble that up. You might remember it better than I do, or articulate it better. But from an operating margin perspective, but then what they have to pass on to the consumer, it'll be interesting to see how that drives or impacts pricing for them, and therefore how the consumer's responding. But the reality is there's no lower price that they're going to be able to find anywhere else. So
yeah, I think that's been the big thing too.
All relative. But is it true that I've heard that Walmart is saying we're going to pressure our suppliers, we're going to do our best to not pass on costs, or did they just first course on that one?
That is absolutely the case too. I mean, I think that they certainly have to. They've come out, at least on the first quarter announcement, said that they were based on tariff expectations that there were going to have to be some price increases. But Walmart has been pretty vocal about pushing back on their suppliers and their vendors to get the best price possible. And to be honest, I mean, if we think back to what caused kind of this easier comparison year over year was last summer, was Walmart put a lot of pressure on the dollar stores with its price rollbacks, which then led to some price rollbacks from some of the other players out there. Now, if you look at dollar stores, I think that certainly there may have to be some element of price increase, but I think they're getting smarter about the way they do it. Perhaps maybe not as magnified, finding other ways to mitigate some of those things. I think that's been part of the story too. Is some of these teams that have been leading the dollar store forever know how to operate, potentially mitigate some of the price increases as well. So Target's another name that we should probably spend a few minutes on here too. It's been an interesting name to watch. And I think that they've been upfront about some of the improvements that need to take place. Generally speaking, we've been down year over year in terms of visitation trends. And I think, as there's been some management turnover here too, perhaps there's some room for some executional improvement on this front too. So I think that they would be pretty upfront in admitting that that the performance isn't where it needs to be. And so it'll be interesting to see, a name like Target. It's a well-known brand name. I don't think you can ever count them out. So I think it'll be interesting to see as we kind of look in the back half of the year what changes in the business are going to be made to kind of recapture some of the people, maybe shifting over to Walmart, maybe shifting to other categories too, maybe the other channels as well. It'll be interesting to kind of see. I'm curious to see what we're going to hear from them in the next couple months ahead about the ways to kind of better resonate with the consumers that may be shopping in other channels here.
I absolutely agree. They're not going anywhere. And the reality is they've had essentially like a perfect storm, right? They have been impacted from operational perspective, their merch assortment, obviously what's going on culturally, I think has had a bigger impact for them. Now, the head scratcher for me was their announcement last week that they're no longer going to do price matching. Part of me was like, why did you have to announce that? But I think that's another signal of maybe not being really in touch with what's going on or how they're messaging and connecting with their customers. And is what that impact's going to be when Walmart is saying we're going to do our best to not do price increases, and we've got Target just throwing up their hands saying, "Oh well, right, we're not going to be able to match our two biggest competitors of Walmart and Amazon."
Yeah, it's a good question. It'll be interesting to monitor too, and especially, as we've talked about already, if nothing else, our data shows is that consumers are hyper aware on pricing, and I think that goes to a number of factors too. It's easier to track prices than it's ever been before through digital apps and online shopping platforms. People have their past transactions; they know. And so I think it'll be interesting to see. It is something that in cases where companies have announced price increases, we have generally seen consumer pushback. I mentioned earlier, we saw it with the egg prices. We saw it when Waffle House and Denny's raised prices in February. So it'll be interesting to see. I'd say, most retailers are raising prices, but they've also been a little bit more selective and surgical about that as well. I appreciate the transparency. It's always nice to see that too. But in this day and age, pricing is a big part of the consideration. And really, I guess if you're going to do something like that, it really comes down to feeling pretty confident about the merchandise assortment and being able to differentiate yourself that way. It's a perfect segue into this too. One of the things that I think has been so interesting, and it makes sense too. We've actually, over the last couple of years, seen consumers shop a wider number of locations than ever before. It really started at the end of 2022. And if you remember, that was the period we started to see a lot of food at home, food away from home inflation. That was when we started to see the big increases. And I think consumers caught consumers' eyes. And then what happened in 2023 and 2024, we saw this big increase in the number of locations people were shopping. And so based on all the data that we had, basically what was going on is people were going to more locations than ever before, largely to seek out deals. I know I can get a good discount on this product, or maybe I'm going to go into an Aldi to finish my shopping basket or try out Trader Joe's for the first time. So they were shopping a wider number of stores in food retail than they had ever done before. But we also saw a downward pressure on dwell time. Admittedly, there was some impact because of buy online, pick up in store. But if we overlay government retail sales data with ours as well, what we were generally seeing too is that the retail spend per visit was also coming down. So that reinforced this idea that people were shopping a wider number of locations. And this is across all categories. We see in grocery, we saw in superstores, gas station, dollar discount. Admittedly, there was partially an element of consolidation here too, as some of the chains took share from smaller players. That was also partially what was going on. We did see a decrease in full service restaurants. That was because of some closures, particularly at the kind of smaller chain and regional level. But the main point where I'm going with all this here is that we actually started to see that behavior stop this year, even with the threat of inflation. It's kind of the point people have kind of locked in the retailers that they go to, and they're not really adding anything new unless there's really something groundbreaking deal that they can't miss, a new product that they can't get anywhere else. It's been really interesting. We're starting to see a reversal in that trend. It's kind of people have locked in that new food retail routine. One of the other categories I think is worth spending a little bit of time on too, particularly as it pertains to food retail, because I think that is really where we've seen a lot of change in consumer behavior, is the C-store category. And what's interesting is there's a group of C-stores out there, Wawa, Sheetz, Buc-ee's is its own category. It's not really even, I would struggle to even call it a C-store, but Casey's and these kind of food-forward C-stores, these chains that have started doing mobile ordering, in some cases adding pickup windows, doing delivery from their C-stores as well, have really started to be very disruptive to the overall food retail category. And the time they're doing it is actually in the breakfast day part. If you look at this, the C-store food leaders are taking a lot of more visits early in the day. So they're starting to become a destination for a lot of consumers. And I think it makes sense too. It's a really relatively affordable product. In a lot of ways, they've taken the technology baton from the QSR sector. It's been kind of interesting to see. It's been interesting to watch that this has been a pretty disruptive category. And what's interesting,
by the way, you taught me a new term, food forward. I never heard that one before. That's great.
Yeah, we're all about innovation, not just with retail visitation trends, but terminology too. But what's interesting when you look at it too, visit loyalty, which we can look at with our platform as well. We see exactly those groups start to see a lot more visits in a month, and some of these other ones, I didn't include them on that first group, but some of these other chains have done a great job on the food innovation side. So, kind of again speaks to this idea not only value. I mean, if everybody was winning just by lowering prices, then everybody would win. There's more to it than just low prices, and I think these groups that have done competitive pricing with innovative and convenient products generally are winning out. So we see it across the C-store category. And then I did want to touch, we're kind of bouncing all around here, which is great. This is the fun part about Placer data as well. We are starting to see or continue to see that luxury retailer, the luxury department stores, continue to hold up pretty well. And this is another one that there is a little bit of tie to tariffs, particularly for some of the European luxury goods. We do see spikes in traffic ahead of potential implementation period. But generally speaking, that luxury consumer continues to be pretty unbothered by kind of the macro sensitivity. Yes, there was a little bit of stock market volatility, and generally that higher end consumer takes their cues from different asset markets, whether it be stock markets and housing markets too. The mid-tier category has been a little bit more under pressure too. So the mid-tier department stores, kind of what we saw with other categories, maybe they're trading at Walmart for a lot of their purchases. That's been an area where we've seen a bit more pressure. It's kind of the mid-tier department stores.
I mean, and that's been a story for quite some time.
Yeah, it really has been too. One other trend that I did want to focus on, I mean, we've spent a lot of time talking about macro, and without a doubt, it's been the number one story of the year. Macro uncertainty and kind of tariffs and things like that. But one of the trends that we're still seeing, we talked about at the beginning of the year and then kind of got overshadowed by everything in macro. This is kind of idea of year of reinvention for a lot of consumers. We started noticing it last holiday. We saw what were the categories that kind of stood out, and a couple jumped out to us, and one was apparel.
Yep.
And you have to think about it, what's going on here, and looking at our visitation data and speaking with some of the management teams in this category, it really came down to this idea of, consumers are, last year was a year of kind of reinvention for a lot of people, whether that be GLP-1s, just adopting a healthier lifestyle. And that did lead to a lot of people, buying a new wardrobe around the holiday. And that has since persisted into 2025 for a lot of chains as well. That's been kind of one of those, kind of bigger picture structural changes that we're seeing among consumer behavior, being masked a bit by other trends this year. But it's one that I think is worth keeping an eye on, because I think this has ramifications later, many years out. Well, it's interesting too. We also see home furnishing doing well. And obviously, home furnishing is a wide-ranging category. There could be a lot of things going on in there. When we look what's going on, it's actually the houseware retailers, so the Home Goods and Home Sense, that are really driving a lot of that. So the thesis we have is that if people are upgrading their wardrobes and trying to show off a new look, a new body, they're also going to spruce up their house. Maybe they're not going to do a big ticket project that you see with a home improvement retailer, but some new home decor and freshen up the look. I think has certainly been a driver of that. The other one too that we see it with, it's actually interesting, is the fitness category. It may seem counterintuitive if people have already lost the weight. Why is fitness up? But I think there's more to it. I think once people have lost weight or kind of committed to a healthier lifestyle, they've stuck with it. In a lot of ways too, fitness has become kind of that community center too, which we'll certainly talk about when we talk about mall traffic as well. But what I think is really interesting is that if you've been looking at the fitness category for any period of time, there's that normal attrition in a given year. Things start out great with that New Year's resolution. People, first quarter of the year is usually really strong, and almost like clockwork, you can see that attrition, that New Year's resolution fall by the wayside. If you look pre-pandemic, it wasn't unusual to see a 20% drop, 20% plus drop in the number of visits as the year progressed. No, what's been interesting is, post pandemic, there's a lot of reasons all of a sudden that attrition curve has started to normal out. We're not seeing that 20% drop anymore. I think 22 is probably some noise from the pandemic, but if you look at 23 and 24, a lot less than we had seen in previous years in terms of that drop year over year. And in fact, I think what is most interesting is that, in a normal year, if you look back the last 20 years of gym memberships, a year like this year would have normally sent people, away from their membership. They would have dropped that pretty quickly as they were trying to save money. But we've not seen that. In fact, we really have almost seen flat visits year to year. Some of that's this Planet Fitness model, the low price, high value model. We've got younger audiences going into gyms. The positioning where they've opened up, I think, has changed it. So we've seen some real structural changes, and I think it also dovetails nicely with this kind of year of reinvention that we've seen for a lot of consumers and this bigger picture trend that we're seeing with our data.
I love all the different dimensions that you're exposing to us around behaviors and traffic. And now we're gonna, I think, dive in. Are we getting into malls now?
We're going to get into malls here. I'm going to skip that one for a second. Yeah, we're going to talk about malls. Let's talk about malls, because I think that is really another area that we've seen a lot of behavioral changes. And it's been something of a mixed year. But although looking at the data, I mean, that's generally squares with what we'd seen. With the overall retail performance, we saw January strong, February weak, a little bit of bounce back in March, April, and May, that normalization period. And we get in June, starting to see that weakness again too. So I think largely we're seeing a mirror of what's been going on. But what has been interesting too is if we start to kind of look, and again, I showed the top 100 retailers as kind of the proxy early on. If I expanded it out to the top 1,000 retailers, which, it's going to cover about 80-90% of the overall retail activity. What we actually see is malls are generally outperforming retail. If we kind of expand that out across all retail categories. And what's interesting about that, we started to notice that was another one of those trends that we saw last holiday, was that visits to malls generally were stronger year over year than what we'd seen for retailers. And I think this just speaks to the idea that people are using malls a lot differently than they were pre-pandemic. And it was largely a shopping destination. You were just going there to shop. But coming out of the pandemic, a lot of mall owner operators implemented changes in tenants. They brought in more attractions, more events, more space for things like that, more things along those ways. And that's, I think, really been kind of key to really changing the fortune of a lot of malls. We saw it earlier, I would say, with open air, but we started to see indoor malls start to adopt some of these best practices that we've seen, kind of in the position. Malls themselves, in a lot of cases, have become destinations of their own. And we talked about the idea of fitness centers becoming community centers and third places for people outside of home and work. And I think in a lot of ways, malls have started to become that too. They become the community hub in some cases. And so a testament to a lot of the owner operators in this category for making changes. And, again, I do think that there still are some malls that are struggling, but I think the malls, particularly kind of the A malls that have done the mixed use strategy and, really changed how consumers interact with them, are sitting much better today than a lot of people probably expected a couple of years ago.
Well, I think it's a great example of tough business and driving innovation, right? And rethinking and pulling in those different experiences were absolutely driven by a rough couple of years.
Yeah.
And, I see it in the world around me as well. There's maybe less malls, honestly, at least in where I live. But the quality of the experiences of the malls are absolutely surpassing what it was pre-pandemic.
Yeah, I think that's a lot of it too. I mean, we've seen just an operational standpoint that they're doing well. Most have gone through this mixed use strategy. Generally, there was an element of re-imaging and remodeling the look and feel of the mall too, and I think that's had a major impact on the perception among consumers. Tenant mix has been so interesting too, and we'll talk a little bit about this too. But a change in an anchor tenant. I mean, moving away from a traditional anchor into something non-traditional can be really amazing in terms of not only driving increased visitation, but expanding the trade area size, bringing in new tenants, attracting new tenants. There's been a lot of development here. And, I think this adage that malls are dead, I think we can put that to rest finally. I think maybe bad malls are dead, but I think there's a lot of innovation taking place in this overall mall category that maybe isn't getting its full due.
Well, and another example that supports this required innovation, you were talking about it, is that a lot of the anchors are closing, right? When we look at the mid-tier performance of department stores, largely those were anchors.
Yeah.
with Macy's closings, and obviously Sears Kmart is no longer a thing in most of the country. At J.C. Penney's, right? So again, yet another driver to force innovation on how to make that space drive traffic back in. And there are some really cool examples out there of repositioning those. I know some like pickleball, they've gone through and done that.
Yeah, I mean, we'll have some examples here in a second too. But the other thing too is that a lot of groups are, I mean, the attractions and kind of the temporary things continue to be a big driver there too. And I bet you didn't expect to talk about the Barbie Dreamhouse tour when you were signing up for this webinar here too. But we're going to do it anyways. And just kind of this is a tour that was a pop up effectively at a lot of these malls, pop up attraction at these malls, and just seeing the visitation trends that continues to drive. But what obviously that's cool in its own, but what's really cool is the repeat visits when we start to see these things. If a mall brings enough of these unique attractions, it does generally have a positive impact on future visits as well as visit frequency. It really it is pretty cool to see these different experiences take place, and so I think that'll continue to be a driver, kind of using pop-up and different attractions and temporary exhibits really is a major driver of that as well. But it kind of again plays this idea that people are interacting with malls much differently than they did just even a couple of years ago. One of the other things that's, I mean, at this point, we've talked largely about A malls. That's where a lot of the mixed use development happened. That's where a lot of that reinvention and reinvestment happened. But B malls are starting to become, that next wave. We're starting to see a lot of investment from B malls. And I think that's going to be kind of the next wave. So maybe the high end malls have started to see that investment, but maybe that B mall, and to your point, this is where a lot of that anchor tenant change, I think, is going to happen. I think a lot of those mid-tier department stores that anchored a lot of these B malls have moved away, are not part of the store closing plans for these malls, and that's left a lot of these malls scrambling for a new tenant. But some are very much finding success. I mean, things like maybe outdoor hunt fish camp, Bass Pro Shop type. We've seen some success in markets like that. I myself, I live pretty close to the Wayfair store that opened up in Chicago, and that's been really interesting to see that change the outlook for that particular mall. So I think that this is kind of something we're seeing. This particular mall, Hawthorne Mall in this case, over the period, just with some of the things that they've changed here, seeing a longer duration of visit, seeing higher household income visit, share of evening visit as they've added some of these attractions. There's some potential for this class of malls, and I think that's going to be the next big story within commercial real estate over the next couple of years, is the fortune of the B mall category. This is another, evidence of kind of the changes that tenants can have here. We talked about kind of the innovation, like, maybe in a non-traditional tenant, but there's also evidence that bringing in kind of a complementary our complementary brands to tenants also has. So fitness, we talked about, kind of the change in the attrition curve that we're starting to see, but malls very much are using that to kind of get visitation throughout the day. So we see that that early morning visit, pre and post this opening of this fitness center, this Lifetime that opened up in North Shore Mall in Massachusetts. You do see a lot more early morning visits. Jackson Crossing, another one there too. It can change the way people interact and make that visitation more consistent throughout the day, not just kind of an evening visit type situation. It's something that's pretty interesting to see what the impact of these non-traditional kind of fitness and other categories can really do for the overall mall. And then one of the things that we noticed too was that the warehouse club, we talked about that being a destination, but maybe there's certain product categories you're getting in the BJ's, but then you're also going to round that out with a trip to Aldi's. So this particular Aldi location opened up at Green Acres Mall, in the middle of 2020. And since then, we've seen BJ's Wholesale, really see an increase in the percentage of visits compared to the baseline. And I think, some of these, these visitation, these pairings of tenants can really magnify and amplify the overall visitation trends. So that's kind of the quick take. I just want to quickly summarize it, and then, Shannon, get your final thoughts here as well. But I think, if we leave you nothing else today, I think obviously macro has been the big story this year. That's been the primary reason for a lot of the volatility that we've seen across the retail sector. Consumers are hyper aware of tariffs, and they're also aware of the prices they're paying. And so if they think they're going to get a better deal by coming in now or ahead of tariffs, they're going to do that. So pricing is very important. I would say pricing paired with innovation is even more important, but pricing is certainly front and center for a consumer that feels very uncertain right now. Early on in 25, clubs and dollar stores are really kind of the big winners. Some of that is just easier comparison for the dollar stores, but also I think that overshadows some of the big merchandising improvements that they've made, kind of getting back to the basics on it and better focused. But it does play in this idea that consumers are looking to stretch household budgets. Food behavior is an area that's seen a lot of change. I'd say probably more so than any other retail category, or certainly in that conversation. One of the things we've seen this year is, again, consumers are really not adding in a lot of new food retailers. They've kind of solidified that group that they trust and they go to, and it really takes something unique or something differentiated for them to come in the stores. Health and wellness is, one of the big trends that we've seen throughout the year, kind of masked by a lot of the macro uncertainty that we've seen, but it's a big trend. And I think that, every year people talk about health and wellness, but it does feel like the last 2 years in particular, it does feel like we've seen a lot more behavior, kind of consumers act on that behavior and really stick with it more than in prior period. Again, malls, people are interacting with them a lot more different. Mixed use strategies have really kind of positioned these as more community hubs and kind of that third place away from home in the office. Or if that's the same place for you, it's a nice way to get out and be part of the community. One of the things that I didn't bring in, I should have showed it early on, but we do have the ability to look at manufacturing data too. And so one of the things we are starting to see, at least throughout this year, manufacturing import data has generally been down on a year-over-year basis. So that will represent both employees as well as logistics partners to these locations. That's been down year over year. And so that potentially kind of leans to this idea that maybe the second half of the year might be a little bit slower than what we saw in the first half of the year, especially if we combine it with the layoffs that you mentioned, Shannon, as well as potential price increases. We could be setting up for, again, a bumpy ride in 2020, second half of 25. So that's a lot of ground.
You covered a lot. I don't really have any other additional takeaways to provide. You gave us a harbor tour around who's winning, who's not. I believe that the second half will be tough, at least probably inconsistent. We'll use the word volatile probably when we do the year-end recap, which I'm very much looking forward to. And what I really appreciated, again, I'm going to reinforce this, is the different dimensions of the consumer, where they're spending money and their behavior. I don't think we get always this multidimensional view that you've shared. So I really appreciate it. I know I walked away with my brain full of facts and discussion points as I, go out there and chat with my fellow retail geeks. On behalf of Retail Wire, thank you very much, RJ and Placer AI, for this very comprehensive view to what's been going on in the first half, and looking forward to talking in the second half and seeing where things arrived.
Thanks, Shannon. I really appreciate it.
All right,